On April 1st, 2026, North Korean state hackers executed a $285 million exploit against Drift protocol on Solana in just 12 minutes, and some of those stolen funds were laundered directly through Hyperliquid before being routed onward to Binance. 5 days later, coordinated wallets manipulated Fartcoin to drain another $1.5 million from Hyperliquid's own backstop vault using the exact same playbook that has worked against the platform at least 5 times across the past 12 months. Arthur Hayes is calling for $150 hype. Bitwise just launched a physically backed staking product on Dutch Bourse, and 4 separate asset managers are now racing to file spot hype ETFs with the SEC. But the structural vulnerability that allows these attacks has not yet been closed, and Hyperliquid now processes roughly 70% of all decentralized perpetual futures volumes on Earth. So, the question that nobody in this industry wants to confront is pretty straightforward. What actually happens to the entire crypto market if Hyperliquid goes under? My name is Lewis, and you're watching the Coin Bureau. So let's begin by looking at the specific attack that turned decentralized perpetual exchanges into high-value targets for North Korean hackers. The Drift protocol exploit on April 1st, 2026 was not a smart contract vulnerability in the traditional sense. It was a 6-month intelligence operation attributed with medium to high confidence by both Elliptic and TRM Labs to UNC 4736, the North Korean unit more commonly known as the Lazarus Group. You see, the attackers posed as a legitimate quantitative trading firm, attended industry conferences in person, deposited over $1 million of real capital into the platform, and built genuine relationships with Drift contributors over months of sustained communication. The actual compromise came through malicious code repositories that exploited vulnerabilities in VS Code and Cursor, 2 development tools used by virtually every contributor in the Solana ecosystem. Once inside, the attackers hijacked governance multisig approvals and used Solana's durable nonce feature to pre-sign malicious transactions weeks before the final execution. A critical time lock on governance changes had been removed just 5 days prior, eliminating the last structural safeguard that could have provided a response window. The final drain took just 12 minutes, collapsing Drift's total value locked from $550 million to under $250 million and triggering contagion across 11 protocols with an estimated $1 billion in total ecosystem damage. This matters for the Hyperliquid discussion because it proved that decentralized Perps exchanges are now specifically targeted by the most sophisticated threat actors on the planet. And the contagion path from that attack ran directly through Hyperliquid's own infrastructure. But while the Drift exploit required a 6-month infiltration campaign and nation-state resources, the recurring attacks against Hyperliquid require nothing of the sort. The vulnerability being exploited is not a code flaw at all, but rather an architectural weakness in the platform's design. The attack pattern, now widely documented as a suicide liquidation, works like this. Attackers identify a low liquidity perpetual market, typically a meme coin or a newly listed token with thin order book depth. They build oversized leveraged positions across coordinated wallets, pump the price to create artificial volatility, and then either withdraw margin or allow the position to become so large that cannot be liquidated through normal order flow. This triggers Hyperliquid's auto-deleveraging system, which is designed to force the platform's market-making vault, known as the Hyperliquidity Provider or HLP, to absorb the toxic position as the buyer or seller of last resort. The attackers profit by simultaneously hedging on external exchanges, meaning the on-chain loss is irrelevant because the real profit is captured elsewhere. Put simply, the HLP vault is being used as a guaranteed exit for anyone sophisticated enough to engineer a position in a thin market that can't be liquidated. Walk through the timeline and the pattern becomes undeniable. In March 2025, the Jelly Jelly incident saw a $6 million short position threaten over $10 million in vault losses, which was only prevented because Hyperliquid's validator set unanimously voted to emergency delist the market and force settle all positions at 0.0095. The following month, an ETH whale withdrew margin from a massive position, forcing approximately $4 million in losses onto the vault. In November 2025, 19 coordinated wallets executed the same playbook against Popcat, wiping out $4.9 million and erasing 3 months of accumulated HLP profits. Then, on April 3rd this year, 7 wallets deposited $1.85 million and extracted $2.78 million from the XPL market at a 150% return on invested capital. And just a few days later, on April 9th, 4 wallets built a $15 million leveraged long in 145 million Fartcoin tokens, spiking the price 57% before it crashed, with the HLP absorbing approximately $1.5 million in losses. Now, these aren't just random market fluctuations, they're calculated moves. To help you navigate this level of volatility, we share our full market research feeds and deep dive alpha over at the Coin Bureau Club. To join, just tap the link below or scan the QR code to see what our analysts are tracking right now. On-chain analysts at Look On-Chain and Hyperdash confirmed that the same wallet clusters were behind both XPL and Fartcoin attacks. Furthermore, PeckShield assessed that the Fartcoin attacker was net profitable through cross-venue hedging despite showing a $3 million on-chain loss. The playbook is documented, it is reproducible, and after 5 successful executions across 12 months, it still has not been structurally closed. Now, you might assume that a platform generating over $740 million in annualized fees would have the resources and the incentive to permanently eliminate a vulnerability this well documented. But that assumption completely ignores the fact that the vulnerability is not a bug to be patched, but a fundamental design feature of how Hyperliquid operates. The HLP vault currently holds approximately $1.68 billion in depositor capital, and it functions by design as the market maker of last resort. When auto-deleveraging triggers, losses are socialized across all HLP depositors and opposing position holders, not isolated to the manipulator. This creates a perverse incentive structure where the vault's own existence guarantees a profitable exit for any attacker who can engineer the right conditions. Historical yields of approximately 20% annually have attracted massive capital inflows, but those returns are described even by supporters as lumpy, carrying significant tail risk that most depositors do not fully appreciate. And there is a transparency paradox that makes the problem even worse. Because Hyperliquid operates entirely on-chain, the vault's positions and market-making strategies are visible to everyone, forcing its own market makers to rotate strategies as frequently as every 3 weeks to avoid being front-run by the same traders that they're supposed to be providing liquidity against. Meanwhile, the newer HIP-3 builder deployed perpetual markets, which allow permissionless market creation through hype staking, are not covered by the HLP vault at all. This creates a 2-tier risk system that many users do not understand, where some markets carry vault protection and others carry absolutely none. But the structural tension runs even deeper than the vault mechanics, because the Jelly Jelly incident exposed a centralization reality that directly contradicts the platform's branding as a decentralized exchange. When that $6 million short position threatened catastrophic vault losses, Hyperliquid's small permissioned validator set voted unanimously to delist the Jelly Perpetual and force settle all positions, an emergency override that bypassed community governance entirely. BitGet CEO Gracie Chen publicly labeled Hyperliquid an overmarketed fake crypto DEX and warned that it poses FTX 2.0 risks to users, describing the platform as immature, unethical, and unprofessional. Glassnode research published in March 2026 reveals that all 24 of Hyperliquid's validators are clustered within AWS Tokyo across the AP Northeast 1 region, creating a measurable latency advantage where Tokyo-based traders connect in 2 to 3 milliseconds, while European and American traders face connection latencies exceeding 200 milliseconds. This means that the entire network shares a single infrastructure dependency with exchanges like Binance and BitMEX, meaning a regional AWS failure could simultaneously halt multiple major crypto venues.
Okay, if you're looking to trade these latest market moves, be it with crypto or TradFi assets, then BitGet is the place to do it. And they've recently released their new BitGet TradFi platform that lets you trade gold and other commodities directly with USDT. Users get access to deep liquidity and low slippage, and if you're feeling brave, you can also use up to 500x leverage too. Ooh. So, scan the QR code right here to sign up and put yourself in the running to net a $50,000 deposit bonus. Nice.
Hindenrank, a DeFi risk rating firm, assigned Hyperliquid a C- risk grade with a 10 out of 10 scale exposure score, the highest possible systemic risk designation, identifying 2 distinct collapse scenarios and 4 high-severity interaction risks. The reality is that Hyperliquid possesses the centralized power to intervene in emergencies and has demonstrated its willingness to use that power, while simultaneously presenting itself as a decentralized protocol governed by distributed consensus. This creates a moral hazard, where users deposit capital into the HLP vault, assuming that they are protected by decentralized governance, when in reality, a small concentrated group retains the unilateral ability to alter, settle, or delist their positions without prior consent. Now, let's address the core question directly, because the systemic risk that Hyperliquid represents extends far beyond its own platform. Hyperliquid controls between 66% and 73% of all decentralized perpetual futures market share, processes a quarterly volume of $492.7 billion, and has expanded into macro asset perpetuals covering gold, oil, and equity indices that trade over $1.5 billion per day. Crude oil perpetuals alone have surpassed $1 billion in open interest on the platform, with traders specifically using Hyperliquid for hedging and price discovery during periods when traditional venues like the CME are closed. This means that Hyperliquid is no longer merely a crypto trading venue. It's financial infrastructure that institutional participants depend upon for macro risk management outside traditional exchange hours. If a sufficiently large and coordinated attack were to hit the HLP vault across multiple thin markets simultaneously, the cascade would be catastrophic. Mass liquidations across all HLP depositors would thin liquidity further, creating a self-reinforcing bank run dynamic where confidence collapse drives withdrawals that make the platform even more vulnerable to subsequent attacks. Protocols holding Hype as treasury assets or collateral face secondary losses as the token's approximately $10 billion circulating market cap reprices. The drift hack already demonstrated exactly how fast this contagion propagates. $285 million stolen from a single protocol generated roughly $1 billion in total ecosystem damage across 11 platforms. Now scale that arithmetic to a venue processing nearly 10 times the volume, and those numbers start to look a little scary. Meanwhile, the institutional blast radius has expanded dramatically in just the past week. Bitwise launched a physically backed Hype staking ETP on Dutch Bank Extra on April 9th. Grayscale has also filed its own S1 for a spot Hype product on the Nasdaq. 21 Shares and Van Eck are pursuing competing filings. So, if Hyperliquid was to suffer a structural failure, the losses would no longer be confined to DeFi participants who understand the risks that they are taking. They would extend directly to retail and institutional investors holding regulated products on traditional European exchanges, who may have absolutely no understanding of the HLP vault mechanics that underpin the entire platform. So, what can you actually do right now to protect yourself from this specific category of risk? Well, first, do not treat HLP yields as risk-free passive income, because the 20% annual return carries documented tail risk from an exploit pattern that has succeeded 5 times without structural remediation. Second, understand the critical distinction between HLP-backed perpetual markets and HIP3 builder-deployed markets, because the latter carry no vault backstop whatsoever and represent a materially different risk profile. Third, monitor on-chain wallet clustering tools from Look On Chain, Hyperdash, and PeckShield for early warning signs of coordinated position building in low liquidity perpetual markets, since this is the documented precursor to every attack that has occurred. Fourth, diversify perpetual exchange exposure across multiple platforms, rather than concentrating entirely on a single venue that controls 70% of the market. And fifth, if you hold significant hype positions, factor in the concentrated validator set as a centralized point of failure that could be compromised through the exact same social engineering techniques that destroyed Drift. Now, to be fair to Hyperliquid, it's not going to disappear tomorrow. The volume is genuine. The team has built a great product that works, and the 97% revenue to buyback ratio creates mechanical price support that keeps the hype token structurally bid. And there's no denying that Hyperliquid is one of the few crypto projects out there that has found product market fit. And heck, Arthur Hayes may even be proved correct about his $150 target by August. Even a stopped clock tells the right time twice a day. But the pattern across these 12 months is absolutely undeniable. The same documented exploit playbook has extracted millions from the platform's backstop vault repeatedly. The architectural vulnerability that enables these attacks remains embedded in the protocol's core design. And the Drift hack proved that decentralized perpetual exchanges are now explicitly being targeted by the most capable threat actors in existence. Hyperliquid's scale makes it the single highest value target in DeFi. The crypto market needs this platform to succeed, which is exactly why it needs to confront the structural reality that a reproducible vulnerability in its market maker of last resort represents an existential threat to far more than just the depositors inside that vault. So, will Hyperliquid use its massive revenue base to genuinely decentralize its validator infrastructure and structurally reform the HLP before the next attack actually scales beyond containment? Or will the same architectural weakness that has been exploited 5 times in the last 12 months eventually produce the catastrophic failure that this entire market cannot afford? Let me know where you stand on this critical risk in the comment section below. And if you want to understand the broader systemic risks currently threatening the decentralized finance ecosystem, you should check out our deep dive video on that right over here. Thank you all so much for watching, and I'll see you again very soon. It's Lewis signing off.